All right, I think we'll start and I'll try to let people in. Joss is also joining us. I don't know if he's here yet, but he will be. So officially welcoming everyone to our webinar tonight about financial governance for committee members. I would like to start this evening by acknowledging the traditional custodians of the various lands on which we work and meet today, and the Aboriginal and Torres Strait Islander people participating in this webinar, in particular the Gunai Kunai people, the traditional custodians of the land on which I work today. I pay my respects to elders past, present and emerging, and recognise and celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and waters of Victoria. And Landcare Victoria takes inspiration from the legacy of Victorian Aboriginal people who have produced food while caring for the ecological systems that life depends upon for tens of thousands of years. And that leads me to our next slide, where I will introduce our key speaker, and I'll be facilitating this evening. This webinar tonight. My name is Anna Pimenta and I'm the project officer for Landcare Victoria. And for the ones that might know and the ones that don't know, I'm also a treasurer of a small landcare group on King Island, Tasmania, believe it or not, because I lived in Tasmania on King Island for 15 years and I'm still connected to that group as a treasurer. Not a good one, but I'll do my best. We also have Andrew McLean, which is our CEO, will be joining us today at some point when he can get out of the train. And our key presenter for today is also a Tasmanian, Joss Fenton. Joss is a CPA qualified accountant, a graduate of the AACD Company of Directors program, and has over 15 years of experience consulting to a wide range of not-for-profits. Joss has recently taken up a part-time position as an South Finance Manager in Hobart, Tasmania. In his spare time, Joss greatly enjoys the Tasmanian outdoors, including walking on Kunayani, Mount Wellington, sailing, bodyboarding, and photography. Joss is I lost myself. And he appreciates this opportunity. Just a reminder that I will take time for questions today, but it is a short webinar, so we'll keep the questions to what we can, which will be around 15 to 20 minutes. But you know, if you do pop a question in the chat, and I'll also ask you to use the chat instead of your voice today, just to keep things so we can keep the questions within time. And I'll apologize right now if I need to cut you short, but we will need to move on if we have too many questions. But just wanted to assure you that if we can't get an answer for your question today, you can email us and we'll try to support you the best way we can. And also there's another webinar coming up on for treasurers where we, anything that we can't cover today, we'll be covering on the next one. I'd also like to thank our funding partners. Without them, this webinar and all the previous ones would not be possible. That is the Ross Trust and the Department of Energy and Climate Action. Just a quick reminder, if you need to use the chat function on Zoom, I'm sure most of you are aware how to use it, but it is there if you need to use it. And this takes me to Joss, and I'll head over to Joss Fenton. Are you there, Joss?
Thank you, Anna. Can you hear me okay?
Yes, we can.
All right, excellent. So yes, welcome from me down in Tasmania, La Taruta. Behind me, you can see a photo I recently took of the Derwent Estuary, and the Iron Pot Lighthouse. I believe it's the oldest, one of the oldest lighthouses, if not the oldest in Australia even. So yeah, thank you everyone for coming along to this presentation, and thank you, Anna, for the opportunity as well. I'm presenting this in my capacity as a CPA consultant. I'm not presenting this as part of NRM. I'm just making that really clear that I'm presenting this as a CPA consultant tonight. So on with the introduction, Anna, if you don't mind going to the next slide, please. So Anna's already done a acknowledgement of country, so thank you for that. I also pay my respects to the elders past, present and future, particularly here in Tasmania or Lutruwita. Thank you. Information provided during this session is general in nature. So please, if you need specific advice for your organisation, because I understand most of you are incorporated in your own rights, so make sure you seek specific advice for your situation. This is more of a generic advice and suggestions, but please seek your own advice for your situation from your own accountants or auditors and so forth. Okay, so the topics we're going to cover today is the introduction, the importance and responsibilities of financial governance. We're going to have a quick look through some financial reports, so a bit of accounting 101 for reading a profit and loss and balance sheet and cash flow statement. We're going to be talking about budgets, forecasts and scenarios, looking at cash position and solvency, the overall governance, financial management governance in particular, policies, procedures, controls and systems. We will leave some extra time at the end of the session for questions or comments and further discussion. We're encouraging at least a few questions as we go along, but we'll just have to be mindful of time. So we'll take 1 or 2 questions for each topic area. And then we'll cut it off and leave further questions for the end. Anna has also explained that if you could please post your questions in the comments in the chat, and then Anna can help deal with the questions through there. The last slide, I've just got some references there, which may be handy references. I'm not sure if Anna is going to give you access to these slides or PDF, but hopefully there'll be some links there for you for further references as well. Okay, so we'll get into the introduction then. So if we go next slide there, please. Anna, I think Anna's very busy letting everybody in and already replying to comments. It's pretty hectic there by the looks of it. So she's doing a great job there. All right, so number one thing we've got to make sure we're doing as part of our financial governance is ensuring the not-for-profit's objectives are met. So the objectives should be clearly set out in the constitution or rules of association for each organisation. So please, if you're not already familiar with that, please go and read your objectives of your constitution, because that's your number one thing to concentrate on, to make sure that the finances are being used to achieve those objectives of the organisation. The next thing we've listed there is the legal duty of care. Whilst a lot of board members and committee members may often rely on a treasurer or somebody with some sort of accounting or financial background or experience, it's great if you can get those people on your board, but each individual board member and committee member must also be aware that they do have a duty of care and they do have a requirement to at least have some level of understanding or be asking good questions around the finances. So you cannot just rely on that one person in the room that might have the experience. You still also you're still responsible for the overall finances. So it's good if you can ask some good questions, or go and do things like company directors course can help you get further experience understanding around this. But please be aware that it's still your legal duty. So please ask good questions when you're in those board meetings of those with expertise, and make sure you're comfortable of the solvency of the organisation and the ongoing financial health of the organisation. There's normally statutory or contractual and grant obligations for good financial management. Most of you be in receipt of grants or donations or other forms of monies. And generally, if you've got agreements in place from those organisations, I'll also make some sort of mention about you having good financial management or governance in place as well. So even just the sheer fact that you're attending this session is helping demonstrate that you're thinking about good financial management and governance of your organisation. So thumbs up for that. Our community and government also expect that publicly provided funds are used in an appropriate manner. I think that goes without saying. Some people talk about the pub test. You know, if you're in the pub and talking about how your organisation spends its finances, you want to make sure it stands up and that it stands up under the scrutiny of other people if they are ever to look at your financials, that it makes sense and it seems reasonable as to what you're spending your money on. Because at the end of the day, not-for-profits are using community monies. Ensure the not-for-profit is financially sustainable. Anna quite rightfully highlighted that's a common misconception in not-for-profits, that the word not-for-profit may sound like you shouldn't be earning a profit, but often the opposite is true. You do need surpluses, at least in some years, to make sure you end up having some sort of buffer there that you can survive from one year to the next. You don't want to be living day to day or week by week. That's a horrible situation to be in. So those that are in that situation, I'd encourage you to work on obtaining some surpluses over a period of time and building up a buffer so that you've at least got a few months buffer up your sleeve is where you really need to get to. And that's what it means to be financially sustainable. We also need to reduce the risk of financial related errors or fraud. I think that goes without saying, but we're just reiterating that. And we also want to be generating accurate and useful financial reports to assist with good decision making and for statutory and grant reporting. So they're the key elements that we see in good financial governance and management. Okay, next slide, please. So financial reports, we're going to go through a simple explanation on this. We'll look at a profit and loss in a moment, and then a balance sheet, statement of cash flows, and then I haven't got an example of a year-end forecast, but I'll just talk around that. Now I'm going to have a go at sharing my screen for this, if that's all right, Anna. So if you can bear with me, I will have a go at sharing my screen so I can demonstrate these financial statements. So if
I might have to stop sharing my screen. I think I'll do that.
All right, so I'm just calling mine up now. Okay, now you may be, okay, can we, Anna, can you just verify that you can see my financial statements there?
Yes, we can. Just got to move to the top if you want to see the top of the, of the Excel. Yep.
For some reason, it's actually stopped me from scrolling on it, which is not ideal. So I may, if you bear with me, I may have to stop sharing and just sort that out for
That's okay.
Anna, if you want to add anything to that introduction while I'm doing this.
Yes, I will. When Joss was talking about the committee responsibilities or duties, we also ran a webinar on committee responsibilities and legal duties, and that the recording of that will be available very soon. If you missed that webinar, you can watch it on our website, through our website, or just actually send me an email if you need that recording. And also I've got Anthony Griffiths, which is also a board member of LBI, has asked a question about any recommendations on percentage of annual expenditure that is a good buffer. Anthony, I'm not sure about the percentage, but I can, from our forum in Orangara not long ago, we had some number. I mean, we usually work on 15% that we charge for admin fee for projects, but actually Julie, one of our presenters, actually mentioned there would be about 30%. That would be the accurate number of, but that's the amount you need to put on top of the grants you apply for. but I can't answer the recommendations on percentage of annual expenditure. I'm not sure about that one. Maybe Joss would know.
The other,
yes.
the other suggestion I've got in relation to that question is that the ACNC does annual reports based on everybody's submitted data each year. They do lag behind a little bit, so it might be a couple of years out of date because it takes a while for them to get through all the data. But the annual report, based on the data submitted, helps give you an idea of what's happening around the country from all not-for-profits. So I'd encourage you to have a look at things like that. Is a useful way of getting a feel for how others spend their money. And I believe in amongst those reports, they gave some indication around overheads and so forth as well. So that's a handy bit of information.
All right, we can see your profit and loss quite well now.
Sure. All right. So with this profit and loss, what I've done, so I've created this for the latest update of the CPA Good Governance and Good Governance Guide that'll be coming out in the next month. The way I've designed this is using the ACNC Standard Chart of Accounts that was produced by QUT, Queensland University, some years ago. So this is based on a standard chart of accounts for all not-for-profits. Now, my recommendation to all not-for-profits is to try and use this standard chart. You don't have to, it's not mandatory, but it's useful in the years to come, into the future. It'll be useful if all not-for-profits are on a similar reporting format for the ACNC and so forth, because it's easier then to compare the figures, like that question we've just had about overheads. It's easier to compare data if everyone's reporting in a similar way. Now, I understand for many of you, you're also doing grant acquittals, and you may think, well, hang on, these don't line up with the grant acquittals, particularly around program costs, for example. Now, we'll go into more of this detail when we have our treasurer's session in the next couple of weeks. But I'm just highlighting this, that this profit and loss is based on the standard chart of accounts, which you may think may or may not relate to your organisation. But I'd encourage you to consider it at a board level, because it's something you could ask your finance people about what, how they've structured their chart of accounts, and if they've considered using the standard chart of accounts, because I'd encourage all finance managers to look at this as an option. So the profit and loss, the overall concept of the profit and loss is to show you your income less your expenses over a period of time. So come the end of the year, that's over a 12-month period. During the year, you may, at the board level, receive a profit and loss for the last 3 months, 6 months, or wherever you're up to in that financial year. So it is the income and expenses over a period of time. So at the top of the profit and loss, you would typically detail all your income sources. So using the standard chart of accounts, you would have your grants from various levels of government, and whether it's recurrent or not is a useful thing to have and important at a board level to understand that. And then you'd have things like donation bequests, sponsorships, and so forth. Now, some of you will have a few of these items, some of you might only have one, but it gives you a bit of an idea of the different types of income. There's a lot more. Has that come when I'm sharing my screen? Can you see the standard chart of accounts, Anna? You can nod or shake your head if you're still looking at the profit and loss.
Yeah, I can see, income, profit and loss for the year.
Okay. I may flick over to the standard chart of accounts later if we've got time. I've just got that open on my screen as well. I thought you may be able to see it. But there's a whole list of other income categories in the standard chart of accounts. This is just giving you an example. So at this point, we've got, in this example, 442,000 of income in the current year, and the previous year was 325. Then typically you would have your gross income less any cost of goods sold. Now, using the standard chart of accounts, your cost of goods sold will be the expenses more related to if you're selling products, generally speaking. And your program costs, which I'll show you further down, normally falls into other expenses. Now, I've noticed in the organisation I've just joined, NRM South, they actually list all their program costs under cost of goods sold. So that's something I'm I'm tackling at the moment with them, whether we leave it there or whether we drop it down into program costs down here further. So just be aware that different organisations do it in different ways. But if you use the standard chart of accounts, your program costs, which most of you guys would have, I'd expect, would actually come under what they call client support expenses, because it's got to do with the government funding and the grants that you're acquitting, and they'd come under there as part of your program costs. I'm just letting you know there's various ways of that showing up on your profit and loss. So without drilling into that in more detail, once again, that's something we can discuss further in the Treasurer's session. We've got the gross income less the cost of goods sold gives you your net income. Then you've got all your other expenses underneath that. So working down to the bottom, got your total of your expenses, 421,000. So in the current year, we've got 15,000 net surplus, or just under 16,000. Previous year, we had an $8,000 deficit or loss. Now I'm using the word surplus because a lot of not-for-profit people get a bit nervous about using the word profit. They're not comfortable with that. So we often use the word surplus in the not-for-profit sector. But if you're happy calling it profit, that's fine as well. Just be aware that that's means the same thing. So that's the notes I've got down there further. You may or may not be able to see that. Might be a bit small, but we've just made a note at the bottom of that net surplus could also be a profit, called a profit, and deficit could also be called a loss. Is it appropriate taking questions there? I know we've got any questions on the profit and loss? No.
Nothing yet, other than no surplus. How does that relate to balance? Surplus, profit, how does that relate to balance?
To the balance sheet. If it's related to the balance sheet, I'll demonstrate that in a moment. Yeah.
Is that what you mean, Jill?
Yes.
Yeah. Now we'll talk about the balance sheet.
We'll relate that in half a moment. Yep.
I have a question. What if the program income is relates to a program that extends over more than 1 year?
Yeah, that's quite common. So just be aware there's some new accounting standards related to that now. So that is can become quite a technical answer as to how that gets shown, whether you have to show all the income in the year that you receive it, or whether you get to put into the profit and loss over the years that you're spending that income. So it depends on how the accounting standard applies to that grant as to where you show that in the profit and loss, whether you show it fully in the year that you receive it, or whether you show it in the profit and loss as you're completing the program, the activity. So just be aware that there's a couple of different ways that can get accounted for. So please talk to your accounting specialists about that, or your auditor, because that is quite a technical consideration.
Another question that might relate to everyone. Do you have, from Nicole, do you have to use these categories, or can we create our own?
Yes, so the account list, as I said, the standard chart of accounts is not mandatory, as in you can have your own list. I'm just encouraging people to consider using the standard chart of accounts because that's easier to compare organisations if people are using a standard chart. Yeah, and it also removes any debate about it, because different people want different things. If you use the standard chart of accounts, it's a given, and it still has flexibility, particularly under program expenses, which is under client support expenses. You can have a whole lot of sub accounts underneath that. So you don't just have to have one category and have a whole lot of sub accounts under that. So you've still got flexibility. Yeah. All right, we'll move on. So I'm just conscious of time. So that's a fairly standard profit and loss, and you'd normally see something similar to that in an end of year financial statements. And I'd also encourage organisations to have something similar to this coming to the board each quarter, or however often you meet. For the board meetings, you may also consider the actual income and expenses compared to the budget for the period that you're talking about. So we'll talk about budgets a little bit further down the list, but just be aware of a report coming to a board, it'd be good to compare it to budget as well. Now, another version of the profit and loss, I won't go into great detail on this one, But this is just demonstrating how you might show a profit and loss for each program. So that should total up to the previous one, which it does in this situation. It's showing, here's our 3 different programs and a large event and our admin or corporate, whatever you want to call it. And that totals what was on the other page. So it's just showing that you can have a column for each program or each area of your organisation. So I won't go into that to great detail now, as I'm just conscious of time. But just be aware there's a few different variations like that you can have. In accounting speak, that's called segment reporting. Okay, now balance sheet. So profit and loss was income, expenses over a period of time. So income, subtract your expenses equals your surplus or deficit. Now your balance sheet is at a point in time. So it's not over a period of time, it's a point in time. So for this example I'm presenting to you, the profit and loss was for the 12 months to the end of 30th of June. And then the balance sheet gives you your list of assets and liabilities as at that end date, as at the 30th of June, okay? So that gives you a snapshot of what your assets and liabilities are at that point in time. So that's the fundamental difference between the profit and loss and the balance sheet. Now, the question we had before, how's the profit and loss relate to the balance sheet? Well, you'll see down the bottom of any balance sheet, you will see in the equity section, sometimes that might be called members equity or surplus funds. You'll see the current earnings, and that should balance to what was on your profit and loss. So the profit and loss total for that 12 months was 15,992, and you can see that in the bottom of the balance sheet, and that's what balances that up. That's why the balance sheet will always balance with the assets subtract the liabilities should equal your equity. It's because the net income and the profit and loss flows through into the balance sheet. I'm not sure how else to explain that without actually spending days and doing a full accounting lesson. But in essence, that's how the profit flows through, or the losses flow through into the balance sheet, into this equity section. Now, the other side of all this equation is your assets and your liabilities obviously go up and they go down during that period of time. And the other side of those entries is what you'll find in the profit and loss. So your cash at the bank obviously will go up and down during the year. And the other side of that entry will be the income and expenses in the profit and loss. And that's why some of you may have heard of the double entry principle with accounting. So coming back to the balance sheet. So in the balance sheet, you should find your assets, which are listed there. Once again, this is an example. Some balance sheets may have other assets listed. And then you've got your liabilities. So it's the assets, which are totaling here 236,000. Subtract your liabilities of 158,000, giving us a net asset balance of 78,000, which equals your equity. So balance sheet always should be in balance. If it's not, I've seen a couple of examples from some accounting systems, you've got a problem. Your accounting system's got a bug in it. Basically, it's not working correctly. But the balance sheet should always be in balance. Okay, so in your assets, the other thing to be aware of at a board level or committee level, your assets should be broken up into what are called current assets and current and non-current assets. Same as your liabilities. You've got current liabilities and non-current liabilities. What we mean by that is that current means they're things that turn over, they go over within 12 months, like the cash is obviously changing all the time. Accounts receivable, monies that are owed to the organisation, normally turn over within 12 months, inventory and so forth. Non-current are assets that we own that we hope to have a life longer than 12 months, like a motor vehicle or equipment to do your work with. So that's the difference between current and non-current. Current are less than 12 months life, and non-current is longer than 12 months. And same with the liabilities. Accounts payable, the amount that you owe your suppliers is something that's changing all the time. How much you owe the tax office. If you've got staff, you've got leave entitlements that are current. And then down the non-current area, you may have some staff leave entitlements such as long service leave that's non-current. If you've got a loan for a vehicle, for example, you'd have a non-current portion. Okay, so once again, current liabilities are things that change within 12 months, non-current are things that are beyond the 12 months. So our assets, total assets 236, subtract our liabilities of 158 equals our net assets of 78. Now, the equity that's balancing this up is made up of the current year surplus or deficit plus our previous years, all added together, of surpluses and deficits. So that's a cumulative amount that will go up and down depending on whether you're having a surplus or deficit in that period of time. Some organisations carve out, they like to take out an amount or sub amount of the equity and put an earmark it as a reserve. So some organisations may have that reserve as part of their unexpended grant monies, for example, and that's only been more recently because of the new accounting standard, the AASB 1058, which means that some organisations have had to bring their grant income to account in the current year, but they haven't finished spending it yet. So this is one way of earmarking this money. Just an FYI, it's a bit more technical, so I won't go into that detail with that now. We can talk about it a bit more in the Treasurer's session for those that are interested. Other reserves, if you are in buildings or property, that often gets revalued every 3 or 5 years or whatever's required for your organisation. When that gets revalued, one side of that accounting entry comes down here into equity, and the other side of the entry goes up here into the non-current assets if you've got property. So it gets revalued up there. So just be aware that's a reserve. It's not, a lot of organisations do not have that. It's normally larger organisations, but just be aware that that's something that can apply to some. Typically, you would have the current period, in this case June of this current year, and you compare it to the previous year. Is quite a common approach of the balance sheet. All right, have we got time for any questions on the balance sheet, Anna?
We'll have a quick question. I'll just take one this time from Anthony. I think it is an important one. How should remaining balance of projects be shown on a balance sheet to give correct net equity? That doesn't include grants that would need to go to funder if organisation wound up. Anthony, do you want to clarify this question? Are you talking about how to show funders the balance? Yeah,
I'm happy with that, and I think I can take that question. I think that's fine, because there's a couple of different things to consider with that. And once again, some of this will get a bit technical. I think we can drill into a bit more in the Treasurer session. But at a top level, yes, Anthony, was it? Anthony, you're right. There needs to be consideration of unspent grant monies. So depending on how the accounting standard applies to you and your grants, and each grant has to be assessed individually, some of it may end up as in a liability area. So in this example, it's saying $10,000 of grant funds have been received, but the organisation can't include it in their income yet because they have to use it for certain things as part of their grant deed. So in this example, they've got $10,000 that they've received, but it's earmarked or it's been tied up in a contractual arrangement with the grant organisation, so they've had to hold it on the balance sheet as a liability. So that's one part. The other part is if they have had to bring the grant income to account in the profit and loss because of the new accounting standard, but they haven't spent them yet, they might want to include them down the bottom here in equity. As I said, this area becomes quite technical, so just be aware that it can be a little bit to work through. But that it is what it is. The grant incomes that have been brought to account on the profit and loss will obviously show in the profit and loss, but we're once again reiterating that if it's unspent grant monies and you've got a special contract in place to say that the organisation has to hand back those monies if they're not spent, well then you may need to include them in the liability area on your balance sheet. Okay.
Yeah, and I think it is important just to check, Anthony, with your funding body, so whoever is funding you, how, what's sort of information they need.
Yeah. And your auditor should
Yeah,
have technical expertise to work out and help you, guide you, whether you include it in the liabilities, in the equity, or whether it just stays in the profit and loss. So please talk to your auditors as well.
We'll keep going. Thanks,
All
George.
right. So statement of cash flows. I'm not going to get too caught up in this because this is a compliance thing for bigger organisations. Smaller ones don't have to show a statement of cash flows at the end of the year. And if you've got a good feel of your profit and loss in your balance sheet, the cash flow statement's really just a mathematical function of the other two reports. So it doesn't need to be a big deal and may not even be required by your organisation. Particularly if your organisation is doing your profit and loss on a cash basis, so it's only showing cash in and cash out, well, then your statement of cash flows, I would suggest, is not required because you've got it on the profit and loss anyway. In the balance sheet, you can obviously see if your cash balance has changed over the year, if it's going up or down. So that's another indication of whether overall you've got increasing cash or decreasing. Anyway, without further ado, the statement of cash flow is basically a derivative. It's a mathematical statement based on the other two reports that we've looked at on the profit and loss and balance sheet. And from an accounting standards point of view, it has to be broken into these three categories of operating activities, investing activities, and financing activities. So this is an accounting standard requirement. And for large organisations reporting to ACNC, they have to produce this report as part of their end of year reports. So I'm not going to go into this one in detail now. I don't think it's worth it. We can talk about it a bit more in the Treasurer's session, if that's okay, Anna. All right. So I'll stop sharing. I don't know if you can go back to my slide and see if I've missed anything in that slide about financial reports. And also, Anna, can you just let me know, is my voice coming through okay? Do I need to be any closer or further away from the microphone?
No, you're perfect.
Oh, good. Thank you. Okay, so we've got this slide back up. So we've talked about the profit and loss, the financial performance, income, expenses over that period of time for the board or management. It could be for 1 month, a quarter, year to date, or the full year. And for the board and committee in particular, it would be typical to report the actual income expenses compared to the budget. We'll talk about budget in a moment. Balance sheets can also be known as a statement of financial position. It's the point in time of the assets less the liabilities equals the equity. Statement of cash flows, I've talked about that. Generally, that's quite end of year. Some organisations want to see it at the board and committee level, but I'd encourage them to focus on the profit and loss and balance sheet because the statement of cash flows can be a bit of a pain in the bum for accountants to prepare for you, to be honest. Year-end forecast. Particularly in the last 6 months of a financial year or the last 3 months, it can be very handy to produce a year-end forecast to see where you actually expect the end of year to be. Particularly if you're looking at grant acquittals, you want to know that the organisation is on track to spend all the grant monies they need to in the current financial year. So a year-end forecast can be very handy. And if you're on a board or a committee, you might want to ask for a year-end forecast basically now. If you're looking at 30th of June, it'd be very handy to know that management has got that under control for the coming few months remaining of the financial year. All right. We also had a note, Anna, talking about cash or accrual basis. I mentioned that briefly as we're looking at those reports. So for smaller organisations, it's quite common to report on a cash basis. So what that means is your income is only showing in the profit and loss when you receive the money, the funds from governments or donations or whatever, and the expenses are showing when you actually spend the money. So that's quite common on a cash basis for smaller organisations. Larger organisations, it's common, it's actually a requirement of ACNC to account on an accrual basis. What we mean by an accrual basis is that income is recorded in the profit and loss when you raise a sales invoice. And expenses are brought to account and shows on your profit and loss when you enter the supplier invoices. So you may not have necessarily paid those invoices yet, but you're recording them as expenses because you've incurred the expense and you've entered the supplier expense into the accounts. An even more sophisticated large organisation may also do other accounting entries called accrual journals, where they're actually accruing expenses in, even if they haven't got a supplier invoice, because they know they've incurred an expense and they bring to expenses to account on an accrual basis for if they know that they've incurred a cost but haven't got the supplier invoice yet. So just be aware there's a increasing amount of sophistication or work required in the accounting as organisations get bigger, typically. So it goes from being cash basis, very simple, to relatively simple accrual basis, doing on invoice basis, and then full accrual if you're having to do a lot of accounting entries every month or quarter to bring to account other items. All right. So we'll move on to that. We can talk a bit more about cash versus accrual in the Treasurer's session. Okay. How are we going for time, do you think, Anna? We're up to, I'm not sure what slide number that is. We're going okay?
This is slide number 11, and it is 6:12. So we've got another 15 minutes, just under 50 minutes.
Yeah, and leaving some time for questions as well. All right. Okay, so budgets forecasts. So we would normally recommend organisations have their management prepares budgets for the board or committee to approve each year. Ideally, you have that before 30th of June if you're financial year. Some organisations go from January to December. But for each year, you generally have a budget that goes to the board and committee and gets approved before the start of the financial year is the idea. Can you, sorry, Anna, just go back one slide to the budget slide? So we would recommend that a management, if you've got staff, prepare it, and it goes to the board or committee for approval. Tracking and reporting, if you've got various programs going on or different grants, you may consider a separate budget for each program or grant is also useful. We're talking about accounting systems in the next slide or a couple of slides time, and you can also consider what your accounting system can handle as far as budgets for different programs. So you may have a budget for each program and project, but one also for the overall organisation is important. Now, as organisations are becoming more dynamic and government funding is becoming more irregular, I think into the future, we need to consider whether budgets need to be a rolling budget of 12 months and it changes during the year. That's a concept. I haven't actually seen that working in an organisation yet. And that's something we could talk about more in the Treasurer's session. But I believe that's a concept that needs to be considered more and more because the world's just changing so much more quickly and grant funds and so forth are very dynamic. So just be aware that going into the future, I think we need to get a bit more sophisticated around our budgets and our forecasting. Budget items to consider. So there's lots of different things to consider depending on your organisation, but obviously the program related costs to actually do your programs, such as materials, subcontractors, staffing, vehicles, and vehicles might be your own vehicles, or you might need to hire vehicles and equipment purchases and so forth. Overheads, your fixed costs such as your management staff or office staff, on costs for staffing such as leave entitlements, annual leave and long service leave in particular, and superannuation is another common on cost. We just lost the slides there for a moment, Anna. Excellent, thank you. And replacement of assets. Okay, so something that a lot of organisations forget to do when they're doing their budgeting is to budget for asset replacement. Because it doesn't show on your profit and loss, a lot of organisations quite often forget to think about their budget for asset replacement. So that's replacing your computers, your vehicles and other equipment. One rough rule of thumb, and we can talk about this more in the Treasurer's session, is you might want to look at your depreciation amounts each year. And if you think about it from a mathematical point of view, if you're maintaining your assets at the same rate that they're depreciating, your asset replacement budget for each year would be very close in dollar amount to your depreciation if you were maintaining your assets. If you're letting your assets run down, your asset replacement budget will be less than depreciation. If you're renewing your assets and going through a program of revitalising your assets, your asset budget expenditure for the coming year, or capital expenditure budget, as some people call it, would be larger than your depreciation. So at a board or committee level, it's worth considering that because you need to know what management is doing with the assets. Are they maintaining the assets, or are they improving them, or are they letting them run down? And comparing your capital expenditure budget to depreciation should give you a rough idea of what's happening there. So that was a very quick snapshot on budget and forecast. I'm happy to be led by questions around this because I've ripped through that pretty quickly. Is there some questions, Anna?
Not at this stage, but I think we can leave the budgets might leave the budgets for the treasurers one. So if anyone has got any good questions about budgets, feel free to email me and we'll add them to our next webinar.
One question I'd ask to the audience, I guess, is any organisation currently doing a rolling budget? Because I'm really keen to hear of any organisations that's got an ongoing budgeting process rather than just doing once a year exercise. So over the next few minutes, if anybody can ping a message if they're willing to and able to, if they've got a rolling budget, because I'm really intrigued to know if any organisations out there are doing a rolling budget.
Yeah, and I would be, there's a message here. No, yeah, I'll be surprised if any is doing, because I reckon, I mean, this is just a guess, but I'd say a lot of organisations don't even have a budget.
Yeah,
and I'm
so
guilty
we'll assume
of that
everyone's,
because it is, yeah,
it is
challenging.
Just to keep the chat down to a minimum, as in don't fill it up with lots of no's, just go the affirmative if anybody's a yes, because we're assuming everyone's a no, unless you say otherwise. So maybe just leave it to the affirmative. I'm just noticing all the no's coming up. All right. Okay, so somebody just posted a message saying an organisation is reviewing that at the moment by the looks of it, so that'll be interesting.
Yeah, that's that's actually LVI, Landcare Victoria. Yeah, but it is challenging because most groups are relying on funding, and we never know what funding is going to come up. So yeah, it'd be a really good discussion for the next webinar, actually.
Okay,
and Anthony says, yeah, can you see that?
Yeah, so I just noticed a comment there from Anthony saying he's on a NRM is just reading that one as well, on a non-NRM board, and they are doing rolling budgets. So maybe between now and the Treasurer's session, if you're willing and able to share any more information with Anna and I, that'd be fantastic, because I'd love a example to share, or at least just to say that's happening, if nothing else. Yeah.
Thanks, Charles.
All right, shall we go on to the next slide then, Anna, unless there's any other questions around budgets and forecasts? Oh, just on forecasts, as I said in the previous slide, what I'm talking about with forecasts, generally a budget is the one that's set in stone for the year, and a forecast is normally a revised budget, or it's a forecast for year end, how we actually look tracking for the year end, because that's often different than what was originally budgeted. So that's what we mean by forecast, generally speaking. Yeah. All right, shall we go on to the next slide then? Okay, so cash position and solvency. So this is a really important thing for people on boards and committees to understand their solvency in particular, because you've actually got a legal responsibility to know that your organisation is solvent. So first of all, it is really important to know that your balance sheet is correct, because otherwise your solvency is meaningless looking at your balance sheet unless it's accurate. The reason why I highlight that, I walked into one organisation and I'd been there working away on their accounts for a couple of hours and thinking, they were okay, they had a balance sheet, they had money in the bank, looked all okay. But then further into the appointment while I was there, I started asking them for some more information. And one of the balance sheet items, one of the cash at bank items was term deposits. And I asked them for a statement for one of their term deposits. And they said, oh, no, we don't have that term deposit. We spent that a couple of years ago. So their balance sheet was fundamentally incorrect. They didn't have the money in the bank that the balance sheet was saying. So if you're sitting on the board or the committee, you'd be thinking, oh, they're solvent, they've got money in the bank. But if somebody's not going through every single item on that balance sheet and making sure it's correct, you may have a problem that you weren't aware of. So for this organisation, they had a lot less money than what it was showing on the report because they no longer had the term deposit. They'd spent it. And the way that they'd recorded that expenditure, the way they'd transferred the money out of their account, the finance officer had done it completely wrong, how they'd entered the entry. So it made no sense and it stuffed up the accounting. So at a board or committee level, they may not have realised that. They might have just kept on relying on that balance sheet thinking it was accurate. So that's why my first point with cash position and solvency is make sure that the balance sheet is accurate. So that's where any board member should be able to ask good questions and say, what are the procedures in place for somebody reconciling all these items on the balance sheet? Has every single item been reconciled before this report has been done for us? Because if it hasn't, is it an accurate report? Fundamental. Right. So once you know the balance sheet is accurate, and you'd hope the end of year balance sheet is correct if you've got a suitable auditor. I've once again seen balance sheets that have been ticked off by auditors and they're still not accurate. So make sure you have got confidence in your auditors and that they are doing a diligent job of checking the whole balance sheet and the reconciliations. Okay. Sorry to harp on that, but I've seen some classic examples where that's not the case and it's a concern. So once we know the balance sheet is accurate, then we can start talking about how's the solvency look. So in the examples that I shared earlier, you may recall the assets, and I might actually go back to, sorry, I'll give the legal definition first. So the legal definition of solvency is you can pay your debts as they become due, okay? So you can't just run a ratio and say we're solvent. It helps, don't get me wrong, and I'll show you a couple of ratios in a moment. But you need to know, and this is where it's often done in conjunction with your finance staff, if you've got finance staff or your bookkeeper, is it's helpful that they know what expenses are coming up and they can continue to pay those expenses as they come up. Now, normally the financial reports are done at a point in time. And if it's looking a bit precarious, if you're a bit worried about cash flow, that's where it's important to have a forecast. But you need to know that are you able to pay your debts as they become due. So if it looks like in 6 months' time you can't pay your debts, I would suggest that doesn't mean you're insolvent today. And you've got time to fix things up and improve your cash flow, okay? Whereas if you can't pay your debts tomorrow, well, I would say you're insolvent today, okay? Now, as to where that changes, is it 2 weeks' time, a month's time, 3 months' time? That depends on the situation. The legal definition doesn't give that to us. So we can't say you're solvent today. Does that mean I can pay my bills for the next week? No, it could be the next 2 weeks or 4 weeks. Because if you think about it, for example, if you're an organisation that's registered for GST and you've got staff, you may not have to pay the ATO for 3 months, but you still have that liability. Okay, so that's where it's important to think about your liabilities and when they fall due as to whether you're solvent today or not. Because even if you have to pay your BAS in 3 months' time, if you haven't got that covered, if you haven't got your current GST and PAYG on your wages covered, then you might start questioning whether you really are solvent today. Because even though you don't have to pay them in 3 months' time, you should already have your GST and your PAYG covered because they are monies you owe already. Okay, so I'm just saying this is a dynamic thing, and sometimes you need accounting expertise to help look at that and review whether you're solvent. I've been called into organisations before when they've been concerned about solvency, and I'll normally have a quick look, and if I get particularly concerned, I will refer the committee or board to an insolvency practitioner because it's such a technical area. So if it looks like it's very close to the line and it may be insolvent, at that time you have to engage an insolvency practitioner, and they're registered with ASIC. They're a special type of accountant, and it gives you protection once you engage them. If you've got a problem, it gives you protection if you engage insolvency practitioner. Okay, so as I said, what solvency mean? It means you can pay your debts as they fall due. And and Anna's just putting up a message to remind everybody, you've got a duty of care. So of all committee members, you've got that responsibility. It's not just the treasurer, it's every board member and committee member. You've got to be comfortable that you're solvent. Okay, and that's really important. Okay, so some ratio and other measures. I will refer, I'll share my screen again, if that's all right, Anna, and call up the reports we're looking at earlier. So on the balance sheet, as I was saying earlier, it's important to know you've got cash at the bank and to make sure that that's been reconciled so it is actually correct. Now, in this organisation, we've got 84,000 cash in the bank, and then we've got some other current assets such as accounts receivable, which is monies owed to you by customers or invoices you've raised to your grant bodies or sponsors or whatever. So we've got a total of current assets of 109,000. Now, once again, this is where it's important to know your balance sheet is accurate. You'd want to know that your accounts receivable is correct, that you can actually receive those monies. Once again, some organisations, I go in there and review it, and they've got invoices sitting on their accounting system which are years old. I would question whether that's receivable and whether it should be part of those figures. So once again, make sure that there's a procedure in place of reviewing what's sitting in your accounts receivable, because otherwise that can distort these numbers on your balance sheet. So in this organisation, we've got 109,000 current assets. And the typical rate, one of the typical ratios is you compare that current asset amount to your current liabilities. Because what it means is, do we have enough in our current assets to cover our current liabilities? So for this organisation, we've got 109,000 in current assets compared to current liabilities of 88,000. So that the ratio is greater than 1, as in the current assets is more than the current liabilities. So that gives you a level of comfort to know that you've got your current liabilities covered. So a typical ratio for that, I'm just trying to find a cell to type that into, is going current assets divided by your current liabilities. And if that's greater than 1, well, that's an indication of solvency. It's not everything. A lot of organisations run under 1, particularly commercial organisations. Most not-for-profits are greater than 1, but once again, it doesn't have to be. And the reason being is because some not-for-profits may have non-current assets, particularly investments, sitting down here in the non-current area. So it depends on your organisation, okay? Likewise, some organisations may know that they've got grant monies coming in next month, and some of these liabilities, such as staff leave, for example, and super is probably not a good example, but some of these other liabilities may not be due for another couple of months. So they know that that's quite common. But just be aware that things like GST and PAYG, I'd suggest you shouldn't be waiting for money to cover them. They should be covered in your current cash balances because they've been withheld from monies you've already received, generally speaking. Okay, so this is where it takes a bit more in-depth knowledge of your balance sheet and maybe a discussion further in the Treasurer's session. But ideally, your current assets cover your current liabilities unless you've got other investments and so forth in the non-current area. So when we talk ratios, it's called a current ratio is a typical one, and that's the current assets divided by the current liabilities. And this example, it gives a ratio of 1.24. So it's saying the assets are greater than the liabilities, and that's a good position to be in. So as a rough measurement, that's one tool. Another thing to look at, one of the ratios I like, it's a bit more involved, is to look at your average monthly expenditure. So I look at the profit and loss, add up all the expenses. So you might have some here. So the 421,000, and I've got a little bit of cost of goods sold there of 5,000. I divide that by 12. So it's 426,000 in total. Divide it by 12. So I've got average monthly expenditure of 35,000. And then what I do, so yep, 35,000. And then what I do is I divide that into the cash at bank and see how many months buffer I've got. So I'm going the 84,000 cash at bank divided by the 35,500, and that's telling me that I have got 2.4 months buffer on an average monthly expenditure. So it tells me at this point in time, I've still got another 2.5 months from when this report was run. And that's not a bad position to be in. We recommend 2 months or more, 3 months or more is ideal position to be in. That's what I'm talking about, building up surpluses over time. Some organisations have got the next 12 months covered. Wow. Not many, but there's a few out there. So, if you get a few months buffer, is also a nice indication of solvency. If you've only got 1 month or less than 1 month buffer left, particularly for your general overheads, your general running costs, I'd suggest that's not ideal, and you need to really look at building up some surpluses to have better financial sustainability into the future. Okay, so there's a couple of ratios that I've shared with you. The current assets, the current ratio, which is current assets divided by current liabilities, and the cash buffer, which is the average monthly expenditure divided into your cash at bank. So they're two common ratios for the not-for-profit sector. Is that okay? How are we going there? Questions around solvency and ratios?
Hi, yeah, we're going well. So 6:30 now, there is. I just thought that point you made just now was a good one for Anthony's question earlier about the surplus. What's the percentage of? That's also a good figure to look at, I think. Okay, we've got a question from Malcolm. He has to go, so that's all. Any other questions so far? We've got time for one question. How does it apply if you're using a cash basis?
Yeah, that's a good question, actually. I'll just have to think about how to answer that. So if you're doing a cash basis, you may not have an up-to-date balance sheet. Well, you wouldn't have an up-to-date balance sheet showing your assets, particularly your liabilities. You won't have your liabilities up to date on a cash basis of accounting. So that can be a problem, quite frankly. So the easy check whether you're solvent is your cash at bank. Do you have cash at bank to cover your expenses for the next few weeks at least, if not months? But yeah, it's very difficult. If you've got a committee or a board reading financial reports and they're just on a cash basis, well, you haven't got a complete picture because it's not showing you what the monies are that you owe. If you don't employ staff, if you don't have any staff, what other type of liabilities might you have? If you don't have any staff or don't have any loans and you don't have many suppliers, that you generally just have a few suppliers that you pay very quickly, it may not be a big deal. Like if you're only talking about a few $100s of suppliers, well, and you've got money in the bank to cover it, well, there's no issue, is there? But if you're talking about tens of thousands of dollars or hundreds of thousands of dollars of supplies and you're not accounting on an accrual basis, I think you've got a problem.
And rent, like Andrew said, rent, rent needs to. Yeah.
Rent, I wouldn't be so worried about because that should be recorded as you're paying it, and rent is normally due in advance anyway. It's a problem, I guess, if you've got a contractual arrangement where you can't break the lease and you might have to pay out like 6 or 12 months worth of lease if you try to break it. But that's now talking about contractual obligations.
Yeah, that's a liability.
And a balance sheet often doesn't always show that. The new accounting standard around leases is supposed to show up. A lot of organisations still don't abide by that new accounting standard. So, yeah, if you've got a contractual arrangement with your lease, that could be an issue as well. And so boards and committees should always be aware of what contractual arrangements are in place if there are lease documents in place. Yeah.
Yeah, thanks. We'll move on.
All right, shall we move on to the next slide?
Yeah.
If you can share your screen again.
Yeah. Okay. Oh.
Okay, so governance, we're talking about policies, procedures, controls and systems. So, okay, so a board or a committee is there to govern the organisation, is to oversee the organisation. For those of you that have got staff, it is up to the staff to actually run your policies and procedures and actually do all that stuff for you. But the board is there to oversee that and make sure there is good policies in place, good procedures, controls and systems, okay? So I'm just making that really clear that if you've got staff, the board and committee doesn't have to write the policies, procedures and controls and so forth, but they should approve them, at least the higher level ones, okay? So that's what we've said here. The board committee oversees the documented policies, procedures and controls and make sure that they're in place and that they're being followed. Now, some people get confused by end-of-year audits because a lot of end-of-year audits don't necessarily test or check all these things, okay? So make sure you consider your audit, your end-of-year audit, because you can sometimes pay extra and ask the auditors to check some of these things for you. So if I'm on a board or a committee for an organisation of a certain size, I would be making sure that the auditors are checking these things at least every couple of years, okay? So when were they last reviewed? I walk into a lot of organisations and they've got policies or procedures there, but they haven't been updated for 5 years and they're no longer being followed. So once again, at a board or committee level, it's one thing to check that there's policies and procedures in place, but are they up to date? Are they being followed? So these are the type of questions that you need to ask at the board or committee level. Are they being adhered to? Once again, that's a tricky thing to test. So audits, a special audit on the procedures and policies and controls is one approach to check that for you. If you're in a much larger organisation, for example, I was on the audit and risk panel of Hobart City Council, where they have internal auditors going there regularly, and we were engaging the internal auditors to check these things on a regular basis. But that's obviously a much bigger budget. Smaller organisations, this is tricky. So it's a matter of asking good questions and getting a feel for those answers, whether it sounds suitable, whether people are keeping their policies and procedures up to date and following them. For really tiny organisations, if you've got no staff, well, you're probably going to struggle to have a whole lot of policies and procedures written, but I'd still encourage you to have a couple of simple ones written to help guide you with what you're doing.
Just on that, do you know of any examples of policies to share?
Yeah, so in the latest, it's not public yet, so I guess you could refer to the older one, the CPA guide for financial management. Actually, there's another guide that we're updating at the moment as well, called Controls and Policies. I think it's called something about controls. So, Anna, I could send the link to that to you later, but we're combining all that into one financial governance document at the moment. I've already authored that. It's just going through their final review stage and getting all prettied up, ready to be made public. So that new updated CPA guide will include all the controls. And when it comes to policies and procedures, it won't necessarily have templates out of the box for you, but it will give you some suggestions on where to go. ACNC has a few things around policies. AICD has some good little policies and templates. In Victoria, you guys have also got NFP Law, is a really good resource of things as well. So it also suggests there they don't necessarily have heaps of stuff in the finance sector, but they for around governance and so forth they do. So yeah, there's places you can go looking for templates. If you're willing to share them amongst yourselves, I think that's fantastic because you're all doing similar stuff. So I think that's a good idea. If Landcare Victoria want to invest some money in standardised templates, that might be something Landcare Victoria could seek getting some grant monies for, or something to start putting together some templates might be an option as well that I'd suggest too.
Yeah, there's definitely some templates in. I'll share some links at the end. You'll be able. There's definitely draft rules for your groups as well. You can use. Yeah, I'll be some links at the end.
ATO is another example, another reference point. ATO a few years ago, I was on a committee for that where they put together some cash flow type of templates to help smaller businesses and smaller not-for-profits manage their cash. But that's really a sort of more simple approach for smaller organisations, and that might be relevant for some of these, for some of the Landcare groups here as well, perhaps. So yeah, the ATO developed some templates as well. So yeah, a few different places you could go. Yeah. So what else were we talking about? Policies and procedures. Yes, I've been here. Okay, is an accounting system in place and is it fit for purpose? So I wasn't hoping to develop a poll. I don't know how quickly and easy it is to do a poll on Zoom, Anna. I'm not sure if it's worth considering rolling one out now, whether we do it during the Treasurer session. I mean,
yeah, we might skip the one. We've got about 15 minutes to go. Yeah. I'm not sure. Yeah, but we can organize it for the next one for sure.
Yeah, I think that's probably a good idea. Yeah, thank you for reminding me of the time. It's almost 1:45. So yeah, some of you guys may be using spreadsheets like Excel or Google Sheets. Some of you may be paper-based. As an accountant, I'm almost allergic to paper these days. I find it hard to grasp how you can keep track of your income and expenses and find it easy for people to review it if it's all on paper. But that's me personally. But if you need to lodge things with ACNC, well, it's got to be electronic anyway. So I doubt many of you are paper-based these days, but I've seen the odd occasion. So spreadsheets is quite common. But I would encourage organisations, as soon as they can afford it, use ideally an online system, because then it's available for everybody. And when one treasurer hands over to the next treasurer, it's easier to hand it over. So things like Xero, XERO is a common system, QuickBooks or Reckon. The MYB's got online solutions, a number of different online solutions. There's lots of systems out there, particularly those three are the more common ones. I'd encourage organisations to look at the more common ones because it's easier to hand it over to somebody else or to get it audited, or for an accountant like me to come in and help an organisation. So yeah, I'd encourage organisations to look at it. As soon as you're turning over, more than, I don't know, 40 or 50 grand, I'd suggest it's a small fraction of your income. You really need to be doing it. So if you're only like 10 or 20,000, I can understand maybe a spreadsheet, but once you're sort of 50 grand above, I'd highly recommend an accounting system. That's just my rough rule of thumb, but depends on the organisation involved. So that's accounting system. So we did have a separate slide on that, which Anna's pulled up. So yeah, some paper-based, which talked about spreadsheet. So spreadsheets, I'd encourage you to consider online options now with that, like Google Sheets. Microsoft Excel, you can share online now, or Apple Numbers, because then it's easier to hand over to other people or share your information. Traditionally, a lot of accountants were very protective of their information and only shared the reports. But the day and age we are now is, I believe, accounting systems should be open for other people to be able to see. It should be transparent, and particularly when we're talking about not-for-profits using community monies, you can still lock away the payroll there and some of that sensitive stuff. But I think the financial statements and the underlying transactions should be more transparent, particularly for board and members and management and so forth. So that's my suggestion, to make it more transparent and available. obviously, as a committee or board level, you don't want to get bogged down with every single transaction, but you want to be able to know that the information is accessible for people. Project cost expenses management. So yeah, some of you will be managing reasonable sized projects. So you may need to consider other third-party apps to help with that when you're looking at managing those projects and the costs and income associated with them. That's where we're up to within RM South at the moment. We're considering how to do that. Xero gives a fairly simple approach to that, which may be adequate. But for the actual management of those projects, we're looking at other options for that. Fixed assets.
John,
yeah.
So can I interrupt you now? Just John just said something that I'm not sure if everyone's seen it, but is mentioning that there's a not-for-profit called Connecting Up, the significant discounts on IT, hardware and software you need the most. So he's put a link in there. So anyone, if you want to have a look, thanks, John. That is a great tip, recommendation.
Yeah, very useful. Thanks. All right. So fixed assets. So that's particularly for running depreciation. Some people use it for a complete asset list because that's handy as well. So Xero has that inbuilt. I declare that I am a Xero advisor, so apologies if it sounds like I'm plugging it, but I just find it a quite useful, cost-effective system. The old MYB system doesn't have fixed assets inbuilt in it. I can't remember where Reckon is up to that. I think it does have fixed assets. No, don't need that. I can't remember actually. And then there's QuickBooks, which is the old Reckon system that's now been taken back over by its American parent. So just be aware there's the QuickBooks, which is the green system, and Reckon, which is the red. We can go into that more with the in the treasurer's session. Payroll. So if you've got staff, please use an accounting system. Like honestly, I've seen people try to use spreadsheets that are paying staff, and it's a pain in the bum as an accountant or an auditor. And your obligations now with the tax office, with what's called single touch payroll, I think it's getting to the point where I doubt you can continue to run payroll on spreadsheets. I think it's getting to the point where you really have to run an accounting system with a payroll system inbuilt. Yeah, that's my thoughts on that matter anyway. Accounts receivable and payables. If you're raising invoices for organisations for sponsorship or grants or other things, then once again, it's handy to have an accounting system that's creating the invoice, and then you can keep track of when you're receiving the monies on them. And same with suppliers. If you're dealing with a number of suppliers and thousands of dollars in supplier invoices, it's quite good to have an accounting system to keep track of all that in. So yeah, that's what I think about accounting systems. All right, we'll keep moving on, just conscious of time. Can you just go back a slide, if you don't mind? Was there anything else on there that, on policies, procedures?
I thought this was a very good question from Anthony. This could be one for the finishing off if you want to delay that one for later, but what are the 3 top questions that committee members should ask to ensure good financial governance? Do you want to leave that one till the end?
Yeah, I think I can answer it now. I'm just going into the CPA guide that I've just updated because we've got a list of about 10 or 12 questions in there. So I'm just having a quick look to see what we listed there. I'm not sure if it's necessarily in order of priority though. Sorry, was it John that answered that question? Anthony, sorry. So I'll just quickly reel off some of those questions we've got in that new guide. Just bear with me. There's about 15 questions in there. So to list the top 3, I might need to take that one on notice. But solvency, we've talked about solvency during this session. I think that's, okay. I've actually got that at the top of the list actually in the new updated CPA guide, is the not-for-profit solvent. So I think that's almost like number 1 question, to be honest. If you started as a new committee member or board member, you'd probably want to even have that answer before you signed on as the board member or committee member. You'd want to know the not-for-profit is solvent. And then is not-for-profit financially sustainable? As to what that means, that depends on the organisation. Is it sustainable for the next 12 months? Is it sustainable for the next 5 years, and so forth? And from there onwards with these questions, I don't think they're in order of priority, because the next third one I had on the list was, has the not-for-profit considered other sources of income? Yeah, that's a useful thing to know, but it's not necessarily a high priority thing, because there's a list of a whole lot of other questions down further. So I'd struggle to probably give a number 2 and 3 question, but number 1 I'd suggest is solvency. Is that okay?
Yep.
At short notice question.
Internal controls in managing bank accounts, says John. Definitely. Yeah.
Yeah, good point. Yeah, what procedures and policies are in place and controls. Can you go back to the governance slide, please? I just have a feeling there was a dot point down there that I may not have got to. Yes. So we talked about standard chart of accounts that I've already talked about earlier. Delegations and bank authorities. So it's a common issue, and like I'm dealing with it now in my new role with NRM South as well, trying to get all that up to date. So I had a meeting with one of our major banks today. They were really good, actually. I had actually face-to-face meeting with one of the local business banking managers, and it was really useful, because as a result of that, we're hoping to get a much higher interest rate on some of our investment accounts. That's actually going to be really worthwhile. But coming back to the point of delegations and bank authorities, yes, it takes a bit to work out. Make sure as part of the process, getting that updated with the bank, that you've double-checked that your office bearers, the committee and board members, are up to date with the ACNC and up to date with the Australian Business Register. Now, a lot of people don't know where that sits. It kind of sits off to the side of the tax office, and it is hard to access. Often you need an accountant, like a public accountant, like a tax agent or somebody, to update it for you if it's way out of date. The practice I previously had did a lot of that for a lot of not-for-profit clients. So sometimes you need a tax accountant to help update those records for you if you can't access it yourself. But it's the Australian Business Register, ABR. That's what underpins the ABN lookup for the government, the registration of all the businesses, and it sits off to the side of the tax office. So yeah, to get the delegations and bank authorities set up, you need to make sure that your records are up to date with the ACNC and the ABR, the Australian Business Register. But yeah, double check that. For larger organisations, you generally have 2 signatories required on all EFTs and cheques. Cheques are being made redundant, I found out today during my meeting with this particular bank. I like that idea, because I'm a bit over cheques. But for a lot of states, they're going to be basically completed with that bank, as in cheques will be turned off next month in June. So it's actually happening. So when we talk about dual signatories, we're talking about EFTs, so sending electronic fund transfers. Okay, I think I spoke about that enough.
And just on that one, I can't remember who suggested that, but I thought it was a good suggestion at some other time, wasn't today, that it is a good idea to have more than 2 signatures at hand. You know, so if you need 2 signatures, have let's say 4 people authorised to sign. So if someone goes on holidays or is not available, you always have someone to sign.
Definitely agree, Anna. And if the proverbial bus comes along the line or whatever, and the world is so dynamic these days, and we saw that during COVID, accessibility of people and so forth. So if you've got dual signatories or even a single signatory, make sure you've also always got, I would suggest, at least double the number you need. So if you only need 1 signatory, you need to have at least 2 people authorised, at least, if not 3. And if you need 2 signatories on every payment, well, I'd suggest you need 4 people authorised with the bank as a rough rule of thumb. Yeah, that would be my recommendation.
All right. So are we good for questions now? We've got about 5 minutes.
Yes.
Yeah. If anyone wants to put something in the chat, or even unmute yourselves, I'll let you unmute yourselves if you want to talk.
Yeah, I'm looking through the questions at the moment. So while if any other questions come in, I'll just pick up on somebody's comment. that they always present their accounts payable and receivables at their meeting. So yeah, list of what's outstanding at the end of the previous month or whatever you're reporting. Yeah, that can be a handy thing to table at your meetings. As organisations get bigger, you may not necessarily want that level of detail at the board level, but at a finance committee level, yes, it could be quite common.
So everyone is quiet. I think everyone must be all very confused, or the presentation was very clear. So looking forward to Thanks,
that
Karen.
comment by Karen, what I'll be interested in, this is where a poll might be interesting to do in the Treasurer's session, is when you say QuickBooks, are you referring to the red accounting system that's been in Australia for many years? Are you talking about the newer green one that comes from America in the last couple of years? And I'm interested to know because they're both slightly different systems now in Australian marketplace. We've got the American, because they took back over the license, and they're different systems. So just be prepared in the Treasurer's session. It'd be good if we have a poll which actually sets out all those different accounting systems. Yeah, Intuit's QBO green, somebody said. Yeah, so that's the American-based old QuickBooks system. Yeah. Yep, so it looks like some people are dropping off. Do you have a wrap up, Anna, or is there anything else you'd like to talk about? There's a reference page after that. Yeah.
So yeah, there's some references pages. There's also some links, and please don't, I will send these slides to all of you, so you can click on all these links for later on. Oh, sorry, that one's just gonna click. No, I don't want to do that. Just a reminder that next webinar, so the one that we've been talking about, the financial governance for treasurer, and I recommend if you want to come to that one, and if you've got any any specific questions, please send me an email. I'd love to know what what are your main your main worries about this theme. And on the 6th of June, we've got risk management and insurance presented again by Juanita Pope. Yeah, just wanted to thank you very much for coming again tonight, for all the returning participants. I'll see you in about 2 weeks, in exactly 2 weeks' time. You should receive a link for the registration very shortly, I believe tomorrow. Yeah, thanks again, and see you next time. And thanks so much, Joss, for taking the time for presenting today from Tasmania.
No problems. I'll hang on the line to catch you when everyone leaves over the next few minutes, if you like, Anna.
Yep. Yeah, we'll get another 5 minutes.
Sure. Because the one thing I was going to ask